We're going to get started in a minute. So I want to welcome everybody to today's Wildfire Risk Reduction Asset Protection Working Group meeting. And thank everyone who was able to make the time to be with us. And thank my team, Emily Rogan and Joel Oucher, Val Brown, for helping with all the underlying work that's going on. And we have a new team member at UP, a young man who had been an AmeriCorps fellow in Colorado, working in some of the wildfire impacted areas, and he's going to be joining us. Ben, I don't know if he's on the call today, but Ben Letourneau, there he is. Anyway, so just really happy to be here with all of you. And up here in San Francisco, it's raining. So I don't know what's happening down in the southern parts of the state, but we're all pretty psyched. Chief Tyler, I'm guessing you're pretty stoked with the rain. So our guest speaker today is Karen Collins with the APCIA. It took me a long time to learn to say that right. Her raining in SoCal. Thanks, Tammy. The APCIA is the American Property Casualty Insurance Association. It's the National Trade Association, one of them. There's a couple of them, but they're the primary one that represents the insurance industry. So they have a very strong lobbying force in both in Congress, but also in a lot of the states with the regulators. They have a very powerful influence on public policy, APCIA, and there are a number of people who are with the organization that I have really good relationships with. And Karen, I think you is it a couple of years now that you have been kind of in sort of the designated wildfire expert? Is that right?
Yes, I joined the trade association just a couple of years ago, but more than 20 years with the industry itself.
Okay. So we, as you know, in these meetings, we have all been sharing information and helping each other in terms of identifying best practices and the programs in various communities that are growing and effectively promoting individual and community-wide risk reduction. We had such an important presentation from Chief Tyler, and then we'll be hearing, we thought it would be really good to hear from an insurance industry voice, because obviously it's critical that insurers be on the same page as much as possible with all of us who are promoting risk reduction, and that we have good dialogue going. So I really appreciate you agreeing to present, Karen. So Karen's going to share her screen and go through her deck. If you have questions that you'd like to ask, you can put them in the chat, or you can raise your hand when she's done, and then we'll do our best to answer them. And if we have any time left over at the end of the hour, I'm going to do a quick recap of the presentation that UP just did. We just hosted a couple weeks ago a shopping help webinar. So I'm going to bring you sort of the greatest hits of what we distilled in terms of consumer tips on shopping for home insurance today throughout California. So Karen, welcome, and thank you again for being with us.
Great, thank you. As mentioned, I'm Karen Collins. My title with the American Property Casualty Insurance Association is Assistant Vice President of Personal Lines. As mentioned, we are a national trade association, and we focus on home, auto, and business insurance. And our focus is really to promote and protect the viability of private market competition for the benefit of consumers and insurers, with a legacy that goes back 150 years. Really, our membership represents all sizes, structures, and regions to protect families, communities, and businesses in the U.S. and also around the globe. My role within the organization is to develop public policy options at the state and federal level on behalf of our members, and as Amy shared, specifically for property insurance and catastrophe issues, and that includes both the resilience and the post-disaster recovery. So I've been really engaged in these wildfire challenges in California and other Western states, but also with federal agencies and the National Association of Insurance Commissioners. Just a quick couple notes about me personally before I get started. I am also a California native, born and mostly raised in the state. I've lived many years in Southern California, mostly Simi Valley, San Fernando Valley areas before relocating to the greater Sacramento area, which I'm now in the El Dorado Hills area, while my husband is a Bay Area transplant. Another quick little fun fact I'll share before I get started is the connection my family history actually has to the wildfire issue. My grandfather spent many years in the hills of Malibu, and his home was one of few in his neighborhood that survived the 1993 Old Topanga North Malibu wildfire that destroyed over 700 homes. I actually can still remember the huge presence of firefighters staged at Pepperdine University and walking his property afterward. He had actually intentionally planted fire-resistant vegetation, quite a bit of ice plant actually, all over his hillsides around his home, and took other measures to harden his property, which helped it actually survive. In the last few years, I learned his home maybe even became a case study for, I think it was CAL FIRE. But interestingly, he was well aware of the risk wildfire posed, as his father before him, my great-grandfather, was one of the earliest members of the Topanga Protection Committee, which was first organized back in 1942 to help address wildfire safety in the popular and growing Topanga Canyon area at that time. So anyways, I say all this to help convey that I'm very familiar with not only the unique and beautiful regions of our state, but also the significant risk wildfire has and continues to pose for all of us, which I also have a very personal stake in as well. So today, with that in mind, I would like to provide an insurance perspective of the wildfire issues, really to help understand the insurance industry's current focus on how to address growing affordability and availability insurance challenges in our wildfire-prone states. I have found it's been very helpful to understand how the industry has previously responded to similar challenges elsewhere. So in my presentation today, I'd like to provide you with a brief historical perspective of how other states have responded following severe catastrophe loss events, including through mitigation and lessons learned. Then I'll highlight how insurers view the current state of wildfire mitigation standards, as well as how the industry views wildfire risk management in general in Western states, and some insights on the constraints insurers have faced in managing this peril versus other catastrophic perils. And then I'll conclude at the end with some insights from an insurer's perspective of the recent regulation from the Department of Insurance and what I believe may be helpful for this group to really focus on to keep progress and momentum going on the resilience front. So let me start with the perspective from an historical look. Coastal states were significantly affected back in 2004-2005 hurricane season, a little over 10 years after Hurricane Andrew had devastated parts of Florida in the 90s. In 2004, it was Hurricanes Charlie, Francis, Ivan, and Jean. In 2005, there was Katrina, Rita, and Wilma. Many here today might be most familiar with maybe Katrina, which devastated New Orleans after levee failures led to catastrophic flooding. The actions that were taken in Florida, Mississippi, and Alabama, as well as other coastal states in response to that really severe 2 back-to-back years of hurricanes, has really provided maybe an excellent roadmap of what to do and not do to address insurance market contraction following very severe catastrophe losses, including how mitigation was eventually reflected in insurance. I think this background is particularly helpful as it relates to our views as an insurance industry on the recent regulation and key solutions ahead. So I'm going to start briefly by highlighting a few of these Gulf states. Prior to 1990, no hurricane-prone state had significant or widespread building codes, nor did any state provide significant incentives to fortify their existing properties. When considering that most properties were constructed between 1960 and 1990, that was a critical issue for existing homes. Florida was ahead of other states because of Hurricane Andrew, which hit in 92. That state implemented numerous measures to stabilize their insurance market, which saw multiple carriers become insolvent after Andrew. In response, building codes were updated and enforced, discounts to harden homes and businesses encouraged in high-risk areas. They created new hurricane deductibles to help increase shared risk, and other insurance-related changes were done to help with funding insurance in the years ahead. Collectively, they helped stabilize the insurance market in that state over time. However, around the time the 2004 and 2005 hurricane season hit, a new study related to hurricane mitigation had been released, and premium credits or discounts based on the study became a mandatory part of the Florida insurance market. Unfortunately, that model was focused on making insurance premiums affordable instead of based on risk. Now, when premiums don't reflect the risk or the true cost of that insurance, that means some premiums will be underpriced. And this can create false signals in high-risk areas as the true cost of insurance are masked or subsidized. And that can encourage more development in the riskiest areas, which lead overall to higher losses. When all of this occurs over a large scale and over time, it can quickly translate to a shortfall in premiums being collected, followed by a need to increase rates, pushing the cost up significantly for everyone. So the approach of this model had significant flaws, and it ultimately damaged the Florida insurance market, resulting in multiple subsequent years of rate increases, which simply wasn't the goal. Moving on to Mississippi. Along with Florida, Mississippi took an early response to the 04-05 hurricane season and included public officials implementing new policies. However, Mississippi took a more gradual and strategic approach to implementing their actions. At the time, Mississippi unfortunately ranked last for building code effectiveness of the coastal states, and it had no regulatory process in place for building codes. So the state conducted a cost-benefit study for mitigation and convened a panel of experts to help implement. This state similarly called for mitigation credits for insurance, however, allowed insurers to implement them on a more voluntary basis and made sure insurers had the ability to base any credits according to the risk. So insurers were able to base the credits on a fortified standard or similar. For those not familiar, fortified is a scientifically proven building standard developed by the Insurance Institute for Business and Home Safety. Many familiar, IBHS. They have helped protect properties withstand the most severe hurricanes with minimal damage. To achieve their certification and in turn a discount, it often can require structural upgrades that go beyond minimum code standards. Now, unlike Florida, insurers were given, fortunately, the flexibility in setting rates and related premium credits for mitigation, amongst other features to ensure companies could individually manage their unique exposure. A 2015 study published by the NAIC, their Journal of Insurance Regulations, had actually compared Florida and Mississippi as two states that promoted wind mitigation following that difficult 2006 Gulf Coast property insurance and reinsurance environment, which included prescribing how mitigation credits would be applied to insurance premiums. Short story, the study found Mississippi's approach to be more effective than Florida's, as it didn't result in any harm to the Mississippi insurance market. Moving on to Alabama. Similar to Mississippi, Alabama also convened a statewide study known as Roadmap to Resilience. The state convened a broad group of stakeholders to identify and implement a holistic mitigation solution addressing not just insurance, but many other industries. Actions taken to support mitigation in high-risk coastal areas included building code improvements, public funding, and adjustments to insurance product design. Among the changes was to help provide more transparency in how premiums are calculated for winds, such as severe wind you might experience from a hurricane, versus maybe other non-wind related perils like hail, theft, or vandalism, for example. In separating out their wind, they helped ensure credits for mitigation that helps reduce damage from wind were then appropriately applied to the premiums directly charged for wind. Now, similar to Mississippi, mitigation discounts were also based on the risk each property faced. The credits offered were again also based on the IBHS fortified certification that I just mentioned, or they were also based on a community-wide building code standard known as BCEGS, or Building Code Effectiveness Grading Schedule. And again, insurers were allowed flexibility in how they applied credits to make sure they were actuarially supported, but also based on verifiable public standards. At the same time, the state rolled out the Smart Home Alabama program, which embarked on an aggressive public awareness campaign to get public buy-in and targeted consumers, home builders, and realtors to educate on the cost benefits of mitigation. The state also offered building permit fee rebates to property owners who achieved a fortified designation to further incentivize individual property mitigation. The Smart Home Alabama program was widely viewed as successful and has since been expanded to a countrywide initiative. So moving on to wildfire. Wildfire is a very unique risk from other catastrophic perils, such as hurricanes, for example, in that to effectively and meaningfully reduce risk, mitigation requires both structural adaptation as well as the management of fuels, and of course, the latter, which must be done on a recurring basis. Also, this mitigation must be done for an individual property, as well as the surrounding community. As we know, wind-driven embers can travel from one property and ignite a nearby or adjacent property, creating a domino effect of losses within a neighborhood. What this means is the built environment, the actual homes and businesses that ignite, actually become the fuel that enables the fire to spread and grow into these devastating conflagrations, which is very unique from any other natural disasters, where the severity of loss typically degrades the further you are from the center of a storm or as a storm moves ashore. It also poses a very unique challenge for the insurance industry, as for all other perils we insure in the private market, the industry has only needed to establish a mitigation standard focused on hardening a single home, with validation done as a one-time event. So wildfire not only breaks that mold, but until recently, the industry has still been developing what that standard should be and how it should be validated. Fortunately, we've seen WUI-specific building code standards emerge. WUI, I'm sure everyone is familiar with, Wildland-Urban Interface, is our built environment that commingles with the natural environment that's prone to burn. We have the new international building code standards that now exist for the WUI, which addresses structural adaptation as opposed to any surrounding vegetation. These codes are, of course, intended to supplement fire codes, though while California has adopted them, few other states have, which creates a significant exposure across the Western US. In California, we fortunately have the Chapter 7A Building Code, which was adopted in 2008 as a statewide code for all new construction, though a big challenge that we had faced in California until recently is that we have state responsibility areas that may have different code requirements that are adopted and enforced versus other areas that were designated local responsibility areas. So at the time that this was implemented, it wasn't truly maybe a statewide code in the way that it was adopted and enforced. But between California and all of these other Western states, what this simply means is that there are millions of homes that have been built over many years that are not wildfire resistant. So a challenge for insurers is that we need recent and clear data on what the code standard is at a parcel level for new as well as existing properties. If the parcel has been inspected, and when was it last inspected, and did that parcel meet the code? And in the wildfire space, of course, insurers need to identify similar information for all the surrounding structures in the community to fully understand potential risk exposure. So California has fortunately made significant strides in addressing this, including with the recent launch of their Safer from Wildfires framework and other changes that will require adoption and enforcement of wildfire-specific codes throughout the state, and with significant emphasis, of course, in higher risk wildfire regions. And there's a lot of other Western states that are watching this very closely. Separately, we are aware that there's development underway for the ICC 605 standard, which will be the next iteration of the IWUI code. This will finally incorporate vegetation management standards in addition to the structural hardening. So once available, we as insurers, of course, would like to see that code adopted in all wildfire exposed regions, not just even the highest risk regions. Now, to help understand building code adoption and enforcement in these high risk areas, insurers have often relied upon the ISO Building Code Effectiveness Grading Schedule, that BCEGS program I mentioned. ISO refers to an independent service organization, or I'm sorry, Insurance Services Office, which is an independent organization that has a lot of information that property insurance companies rely on related to risk. As mentioned, insurers in a lot of those coastal states have offered discounts based on this BCEGS data as an alternative to those who might be eligible for a mitigation discount if a property has met the IBHS fortified standard. Now, again, to reinforce, fortified is above minimum building code standards. And a big point to underscore also with ISO's program is it involves an independent verification process, which provides insurers a credible data source. Also important to note is this program focuses on that structural adaptation, as I mentioned, not vegetation. So while insurers have often leveraged this BCEGS program in coastal states to provide premium credits. It's just not been a robust enough program for insurers to leverage for wildfire purposes, at least not at this time, unless they were to expand that program. But we've continued to highlight this program as one that could potentially provide some opportunity in how wildfire states manage data collection and assessment related to building code adoption, enforcement, and really structural adaptation, and what they can maybe use it with opportunities to communicate to other stakeholders, insurers included. So again, in the wildfire space, big challenge for insurers is what is the code standard for structure and where does a parcel fit against that? Moving beyond the structural adaptation of the individual home, there's a number of community programs such as FireWise and Fire Safe Councils in California, which promote wildfire mitigation. Obviously, many on this call are quite familiar with these. We in the insurance industry view these as programs that have done an excellent job in building community awareness of risk and providing steps to reduce risk, including structural adaptation, home hardening, and fuels management. So we very much support and appreciate the efforts of these organizations. Just quick, for example, the FireWise program has their specific steps to reduce risk, focusing on their specific zones around the home, and providing that community level recognition for the collective efforts. However, within these community mitigation organizations, there is still potential for wide variance in the level of participation and action taken to reduce risk. Put another way, because a property falls within a recognized FireWise community, it doesn't guarantee an individual home within that community was in fact mitigated. Thus, while there's wide insurance industry support for these programs, some insurers are hesitant to rely on these organizations as maybe the best credible source for verifying individual property mitigation, as participation is maybe viewed as a proxy for mitigation efforts rather than evidence of actual mitigation done. Wildfire Partners is another organization focused on mitigation. This is actually based in Colorado. Unlike FireWise and Fire Safe Councils, this program provides an independent assessment of individual property, can assist in mitigating the property, and facilitates an independent verification that mitigation has in fact been completed. As this program provides independent and credible verification, properties in high-risk areas that pass their assessment may become automatically eligible for coverage by some carriers. At this time, to my knowledge, no insurers are offering premium credits for the mitigation. They are leveraging it strictly from an eligibility standpoint. Now, IBHS has done an excellent job in developing their Fortified program, which I mentioned earlier. This program focuses heavily on building safety research that goes, again, above minimum code standards to create more resilient communities to withstand storms such as potentially a Cat 5 hurricane. Their program also facilitates independent inspection and verification of mitigation done at the property level that can then result in earning a Fortified designation. Insurers view this as a highly regarded organization, and we often have our companies look to them when choosing to offer premium credits for mitigation. Unfortunately, their Fortified standard is not focused on wildfire because it's strictly focused on wind and earthquake. Though following many years of wildfire research, IBHS has, of course, developed their suburban wildfire adaptation roadmaps, initially launched in 2020, which has been a best practices guide, clearly helped fill a critical gap in the wildfire space. And I'm not going to go into all the details because you've heard from IBHS quite extensively, but they've got obviously the various vulnerabilities that they've explored scientifically and their core set of priority actions to really effectively reduce a home's vulnerability. As we know, IBHS launched here in California their Wildfire Prepared Home designation, which translates all of that technical reports into a standard that homeowners can then meet. The designation focuses on a set of requisite actions that, when taken together, will significantly reduce a given property's risk. This is done by creating, of course, that minimum 5 feet of non-combustible zone around the home to really try to break those pathways that lead to ignition of the structure. And you guys have heard this from so many different folks that have presented, so I won't go into a lot of detail. But just it's really underscoring that set of actions to meaningfully reduce risk that are needed to then obtain their designation. And you can see here the items that they view as most critical in brown must each be done and verified, with some pieces confirmed annually. And then those items in blue are their additional items that can further reduce risk and earn a higher plus designation. We, as an industry, support them, and they are going to be expanding this to other Western states. So we're fortunate to have it here in California first, and I believe they will also be rolling out a community version designation as well, because of what the science obviously is showing with individual and community hardening that are needed to reduce risk. We strongly recognize their research, and we are actively promoting this and look forward to having that expand to hopefully other Western states sooner versus later. But let me talk briefly on insurance discounts, and I'll kind of continue from there. Within the insurance industry, our primary objective isn't to simply provide a discount, but rather to prevent homes from burning. This is what our research has been focused on, as this is what will ultimately, we believe, help resolve the affordability and availability issues. Insurance is the cost of claims, and as we reduce losses, then premiums will follow that change in risk. Now, insurers must base premiums on actuarially sound standards, and any premium credits must be risk-based, meaning the discounts must reflect the actual reduction in risk. In this case, their likelihood to prevent homes and businesses from igniting and burning. The insurance industry has been aggressively studying this issue to actuarially quantify the value of wildfire mitigation measures, meaning translating those actions into dollars. This is critically important to understand so insurers can offer premium credits with confidence that they will not result in harm that over time can lead to higher rates. While some data and early analysis is certainly emerging on this issue, the industry has not quite reached that point of having fully credible data. So the research is still ongoing. Here in California, CDI has, of course, been at the forefront of the issue by recently adopting their regulation that now requires insurers to consider and reflect mitigation efforts in rating. And I'm going to provide some more insight on those shortly. While the issues of premium credits are studied in the interim, insurers are also facing increased pressure from a variety of challenges, including the severe multi-year period of wildfire losses, higher prospective or future loss costs, and increasing exposure. In California, we've unfortunately felt the worst effects of recent losses. Data from Aon has indicated that since 2017, 8 of the 10 costliest insured wildfire events in the world have occurred in California. According to an analysis from a highly respected actuarial firm, Milliman, the losses in 2017 and 2018 were so significant that they wiped out over 20 years of underwriting profits for homeowners insurers in California. Recent data indicates that on a cumulative basis, the homeowners line of business has remained unprofitable if you go all the way back to the 1991 Oakland Tunnel fire, as shown here. Now, reconstruction costs have also been extremely elevated due to the recent inflation and supply chain disruptions we're experiencing. And the increased volume of natural disaster losses has been further straining demand for skilled labor and materials, which is simply resulting in longer timeframes needed to rebuild and further adding to claims inflation. Here you can see some costs for reconstruction materials and labor, which are up over 30% in the last couple of years. The orange and blue bars on the left, kind of just outside of that box, represent the skilled labor and materials, and individual commodity cost changes are kind of in that box on the right in the blue, which is what's driving that we've seen the overall increase in the cost of goods for home reconstruction. But in addition to costs, overall exposure for insurers is continuing to grow. From an environmental perspective, the Western US is currently in a mega drought, which is a severe drought that's been persisting for at least 20 years. A report released back in mid-February suggests it's now the worst drought going back 1,200 years. When combined with higher average temperatures, we are seeing fires ignite more easily, spread more rapidly. We've seen higher average acres burned per fire due to extremely dry vegetation. Fire seasons now widely viewed to be year-round, as most recently evidenced by the Marshall Fire that devastated communities outside of Boulder, Colorado in late December last year, or also the Colorado Fire, which raged in California's Monterey County in January of this year. Some studies have likened the impacts of climate change and drought on our vegetation as having similar effects of a chronic illness, where even recent rains and cold winter weather don't necessarily prevent fires from developing. And separately, we simply have more homes and communities that are continuing to be added in the WUI across the entire Western US. Here are a couple quick visuals to help illustrate this growth in the WUI. The chart on the left is from the US Forest Service, which shows where the wildland-urban interface grew the most between 1990 and 2010, so a 20-year period. In short, during that period, the WUI was the fastest growing land use type as it increased from just under 31 million homes to over 43 million homes, a 41% growth in that 20 years. And it expanded in area from 143 million acres to 190 million acres, or a 33% growth. The vast majority of new WUI areas were caused by new housing, not an increase in wildland vegetation. The housing grew by 97%. The highest gains in houses and people, of course, have happened in the South and Southwest. California actually didn't rank as high as some of the other Western states, simply because we had a higher starting population than many of the other Western states. So the growth rate wasn't quite as substantial. But you can see the chart on the right from Cape Analytics and Hazard Hub, which shows that housing growth in the WUI since 2011, so the most recent decade, has also really continued to accelerate. In the last decade, California led the states in the West for the highest number of new homes built in high-risk wildfire areas, followed by Utah. According to data from Verisk, California ranks the highest for the estimated number of properties at high to extreme risk, boasting over 2 million exposed properties, which is nearly 3 times more than the next highest state, Texas. So this expansion in areas at high risk for wildfires, with what we have until recently seen as much enforcement of the WUI specific building codes, has not only drawn the attention of insurers, but other researchers in the scientific community. Recent studies are continuing to emerge which identify land use policies in high-risk areas as a significant contributor to recent insurance market challenges, particularly in the wildfire space, and a few of these are highlighted here. We in the insurance industry are trying to amplify that these are among the underlying issues that are leading to the current availability and affordability issues that we're now seeing affecting consumers in not just California, but several, a growing number of Western states. The insurance market challenges are often a symptom of broader issues that we in the industry have begun to, push policymakers to examine and try to help address. Now, for example, a USA Today article last year noted zoning is a local matter, and politicians are most interested in keeping property values high and increasing the tax base with more building. But the article went on to note that mortgage companies continue to sell in risky areas as there's no incentive for them to stop providing mortgages in high-risk areas when banks can easily unload them to the secondary market. However, it is the insurers that are left to foot the bill when these communities are sadly lost to wildfire. So given the recent losses and the increasing exposure without, unfortunately, adequate enforcement or mitigation, the insurance industry has been forced into a difficult situation of needing to assess at what point does the risk exceed our capacity to pay for the resulting losses. Now, as I touched on earlier, when faced with growing catastrophic exposure, insurers typically might respond in a few different ways. They can raise premiums to pay for the cost of future losses. They might consider adjustments in product design. So, for example, in hurricane or hail-prone states, they might require a separate higher deductible for catastrophe losses, which can result or help in reducing your premium. They might also limit their exposure by writing fewer policies or requiring certain mitigation to reduce the chance of loss as a condition of writing coverage. Now, as a result of state-specific constraints in California, insurers are not able to quickly and easily adjust premiums or make adjustments in product design. So what we are seeing is insurers are being even more disciplined in their underwriting to manage these risks. Now, some insurers may be more exposed than others, which essentially means that if a risk has been fully mitigated, there may still be differing underwriting or pricing decisions by individual carrier. And this has become even more pronounced recently as the costs of reinsurance have climbed significantly, resulting in one of the hardest reinsurance markets in recent years. For those not familiar, reinsurance is like insurance for insurance companies to help pay for losses when larger catastrophic events occur. We have seen, of course, several years of significant catastrophe losses, both from wildfire, hurricanes, and other perils, which is unfortunately pushing up the cost for reinsurance or other financial capital insurers need to pay for catastrophe losses. So this is not unique to California, though we're, of course, seeing these challenges. So insurers are working to delicately balance what exposure they can responsibly underwrite while ensuring sufficient capital to pay for the potential future losses. While these are significant in California, as I mentioned, not unique, we are seeing this pressure in a lot of states. In fact, in hurricane-prone states such as Florida and Louisiana, we have unfortunately seen a wave of insurer insolvencies in the last year or so. Insolvency is essentially a bankruptcy in insurance terms. These companies were unfortunately unable to raise and maintain the necessary capital to cover what was their expected liabilities. Now, to help manage through such issues, catastrophe risk models have grown to become a critical tool for insurers to help identify and assess individual risk. Wildfire-specific risk models have done a great job of mapping historical fire footprints along with numerous other characteristics to help identify regions most prone to wildfires. These models also incorporate how wildfire risk may evolve due to climate change and increasing drought and the continued expansion of communities in these regions. As the footprints of communities grow and evolve and surrounding fuel loads increase and are abated, risks for insurers also evolve, which may result in that varying underwriting and rating treatment by carrier. Models increasingly used by insurers often may include aerial imagery, such as satellites, to help assess roof condition, vegetation adjacent to the home, and other features of the surrounding area, such as slope, fuel load, and other items. However, it's that ground level inspection and access to other data records or some other very high resolution imagery that's needed to help verify a building's features that are not visible from above, such as siding material, types of windows, enclosure of eaves and vents, as well as inspect for potentially combustible items, such as maybe those stored under decks. Modelers have been working to expand their features and have accelerated those efforts further, of course, in response to CDI's recent regulation. There is emerging technology to help accomplish this, which a few vendors have shared they will have in place to help insurers, though it likely will take time for many other vendors to incorporate such features into their models. Of the models that have been able to incorporate such features and put into use, these tools are helping carriers identify properties that may be situated in high-risk regions, but not overly exposed. In other words, these tools are helping insurers find what you might consider the diamonds in the rough and enabling them to underwrite more risk than they otherwise would have considered in these high-risk regions. So from the perspective of insurers, our overwhelming priority when disaster strikes is to help customers rebuild their lives, restore their property. Also, insurance is a highly competitive industry in which companies want to grow. So we're very similarly and strongly concerned about the issues of affordability and availability insurance here in these WUI states. However, with the cost and frequency of wildfires on the rise, to ensure companies can fulfill those commitments to their policyholders, they're diligently working to manage their overall exposure and collect appropriate and sufficient premiums to cover the risk they do take on, with, again, full consideration of not just the recent, but future costs. Insurers are also working to ensure they have access to sufficient tools to help them identify and assess those individual risks as part of managing their overall exposure. And perhaps most importantly, to help keep coverage affordable, insurers are continuing to advocate for solutions that help reduce risk, code adoption and enforcement, funding to help property owners harden their homes and businesses to those WUI-specific standards, and access to shared data for insurers to help recognize properties that have been mitigated. So the biggest leap forward this year in that effort has been the emergence of a science-based wildfire mitigation standard, and really what's been a coalescing around that standard, which has long been needed to then build additional policy actions upon. Again, we as the insurance industry really strongly support the science behind the work that IBHS does and the emergence of their wildfire prepared home framework. And we're actively promoting the science to policymakers in all the Western states and at the federal level. Insurers work closely with CDI and state officials to highlight this research and findings, which I believe did heavily inform the Safer from Wildfires framework. And as such, Safer from Wildfires is largely consistent with the IBHS Wildfire Prepared Home Framework, which is good because that means insurers will be able to leverage that program as insurers prepare to file new rating programs or rating plans rather. The big key again to underscore is the science strongly indicates a systems-based approach to mitigation that's needed to really meaningfully reduce risk. Thus, as it relates to the discounts under CDI's regulation, while insurers are going to be required to provide some form of premium credit for mitigation action, CDI did also provide significant flexibility for insurers in determining the amount of credit based on supporting data. So as such, actions that have been shown to result in meaningful reduction risk are what will likely earn the most meaningful discount. And that science is what the IBHS Wildfire Prepared Home Program offers, an evidence-based standard that can result in a designation earned according to that set of actions that have been independently verified. On the community side, there is the FireWise USA program and the new Fire Risk Reduction Community List. Again, insurers have very strongly supported the FireWise program as probably the best community program currently available that we've been able to leverage across multiple states. The NFPA has done an excellent job in building out their program, including providing an automated method for insurers to obtain community data through a third-party vendor. And as a result, there's already some insurers providing discounts for this program here in California. Insurers are still working on building out similar infrastructure to be able to quickly and easily capture information regarding properties that are situated in a fire risk reduction community, particularly in their quoting applications. That workflow is complex. It is highly likely insurers will need to implement new arrangements with third-party vendors to be able to capture and relay this data, which unfortunately is very costly to operationalize. Also, since those communities have only just emerged, there's going to likely be very little actuarial evidence to measure against to generate meaningful support data. Thus, if I was one that placed bets, I would anticipate that insurers may be cautious and conservative, at least at this time, with premium credits they decide to offer until more data becomes available that can provide greater evidence and actuarial support of a reduction risk that merits a more meaningful premium credit. Now, such decisions are, of course, going to vary company by company. So property owners will simply need to shop around to see how individual carriers reflect and reward those mitigation efforts. To help maybe further frame expectations on timing, according to the regulation, insurers have 180 days to submit a new rate plan filing that reflects the mandatory factors and premium credits. Now, earlier this year, CDI had also shared in their initial statement of reasons documentation that their average filing approval timeframe is 167 days. Now, that's based on reviews that they completed between January of 2019 through most of 2020. So while insurers have up to 180 days to submit their filing, it could take almost the same amount of time for the department to process and approve these filings, or more, given the large influx of filings expected for both residential and commercial property lines. Then once that filing is approved, a future effective date is determined to allow the necessary time for insurers to program and then implement those. So I say this in short to say that this is probably going to take the better part of a year or so to get this whole process up and running. In the meantime, what community leaders should really be focusing on now is communicating the best mitigation options for consumers that will result in the most meaningful reduction in risk. Laying this foundation now will help prepare those properties to begin earning premium credits once they become available. However, we also need to keep in mind that insurance incentives are really only one part of the solution. Similar to the very successful Smart Home America program, we in the industry are strongly encouraging local, state, and federal lawmakers to look beyond just insurance incentives as the only value proposition to promote action. There needs to be a larger and more holistic view of benefits that we identify, develop, and communicate to homeowners and communities to drive action and reduce risk. We really need to emphasize intrinsic motivating factors, which includes the safety of our communities, families, and firefighters, and protecting the precious memories and peace of mind that can be difficult to replace after a fire, while also providing those extrinsic motivating factors such as economic incentives. Insurance discounts are clearly one of those economic incentives. However, there's a number of others that have been leveraged in other disaster-prone states, and I'll highlight maybe a couple of those quickly. I mentioned in coastal states, earning that IBHS fortified designation has enabled property owners to earn a rebate of up to 25% of building permit fees. Other states have provided funding through grants, low interest loans, or income tax credits for costs to retrofit homes. And that can include, in some cases, sales tax credits for materials purchased to retrofit. In California, CAL FIRE started a cost share pilot program that matches funding to support mitigation, which is great. In addition to these programs, we in the insurance industry are also working with the construction trades and realtors to help develop consumer education on other potential return on investment benefits that can be realized potentially from retrofitting their homes, particularly maybe to the IBHS wildfire prepared home standard. These benefits might include potentially increasing a property's resale value and improving insurability, which in some regions is a huge cost consideration in real estate transactions. There's also new research that emerged from IBHS and Headwaters Economics, just I think in the last month or two, that shows the difference in cost for new construction is minimal to reach an IBHS wildfire prepared home designation. So this should be a huge low-hanging fruit priority for community planners in regions that are still building out new developments. So to wrap up, catastrophic wildfires are devastating, as we've all unfortunately seen. And while insurance is a critical piece of the puzzle, there is much more needed to help resolve these challenges. And we in the insurance industry are actively working with a large group of stakeholders across the public and private sector to help address the underlying issues and then expand resources to support mitigation efforts. To move the needle, we need to be employing all of these tools to help reduce the likelihood communities will burn down. These are what will ultimately help resolve the affordability and availability challenges in our state. So with that, I do want to thank all of you, and Amy in particular, for the time you've given me to highlight these challenges and share kind of how we in the insurance industry view what will improve these conditions. If you would like to know more or know others who would benefit from similar information, I've recently written a white paper series on these issues, which was just published actually last week, and I'm happy to provide links to the series. I believe it's an incredibly beneficial tool that will help provide, again, a foundational understanding of the complexities of the wildfire issues as it relates to insurance, and strongly recommend it for any policymakers that are focused on this issue. So with that, Amy, I will turn it back to you and welcome any questions you guys have.
All right. Well, thank you so much, Karen. We have a few minutes and we got some good questions, and I have two quick ones. One is that I put in the chat a link to a page on the California Department of Insurance's website where they have all the names and links for companies that are currently offering discounts. And of course, we all have been praising USAA. I don't know if they're a member of APCIA, but we've been praising them for giving a 5% discount if you live in a Firewise community for quite some time. So I guess my one question, you mentioned that insurers cannot give a discount unless they really, have all the data. And yet there are quite a few insurers that are already doing it. So I guess, can you speak to that first?
Yeah, no, USAA has definitely been one of the early adopters on recognizing Firewise communities. I forget how long they've been doing it, but it has been for a handful of years, and there's been a few additional companies that have rolled some out. I think some of them might have been a little bit more pressure driven from CDI as they're trying to, of course, help move that needle. Insurers can certainly venture into some of this, but as I cautioned, if you get ahead of the science, you can overshoot. And that can create issues and challenges with what that can do over time and needing to readjust. And so what we saw in a lot of the coastal markets with the fortified program, and where we saw states that mandated discounts, I believe that there has been ongoing studies and actuarial support that have kind of created more of an iterative process where there's been some recommendations for some early targeted premium credits that have been refined as more data comes in. I think CDI tried to allude to that. So if USA was an early adopter, they've probably been able to maybe study and measure that. I have heard anecdotally that what they put out maybe hasn't translated exactly to what the risk benefit truly was, and maybe has had to make adjustments. They are not one of our members, so I don't have specific insights to that, but that is one of the challenges of getting out ahead of it, is if you do under or overshoot, what that can translate to. And in a market that is so difficult from a regulatory standpoint, just because of the constraints that are in place by design in California, it's not easy to adjust to those when you don't quite get it right. So insurers are very concerned with trying to get too far ahead of it, knowing all these other challenges exist. And so if we were in maybe a different state where you can just make a quick rate adjustment and fine tune it and you're off and running, they might be more comfortable doing that. But in California, this regulatory environment is particularly challenging. And with the recent losses, it's even more of a sensitivity to insurers in getting that far out. But to your point, there's a competitive advantage of being out there first. If you get it right, you might have a more competitive product because you're offering that. So there's that trade-off. But I think that, again, the recent cost is where insurers are a little bit, gun shy on some of those.
Yeah. And, since you mentioned a couple times of the mega fires and the losses, your chart that shows the profitability, I know that, insurers got some $13 billion from the PG&E settlement from the camp and the tubs. That's a pretty big offset to your losses. Is that get reflected in the chart that you shared?
I would have to go back to Milliman to confirm that. We've got the specific data notes that has the disclosures, right. But I know there's a lot of money from those settlements that also had to be ceded back to reinsurers as well. So there is not necessarily, once it's received, that it's right there. There is a lot of moving parts to a lot of that. Understood.
Okay, let me throw you a few easier ones. Those are a little tricky. So we've got, how about, are insurers recognizing CAL FIRE's risk reduction communities? I'm not familiar.
That program was just stood up in, I believe, June or July. So with rate filings, rate plans are in effect currently today. It is not likely that they are reflecting that, but with the CDI regulation, they will be required to reflect that. The amount of what individual companies choose to provide for that is the unknown. That's going to be a decision by each individual company with what they can actuarially support. They have only just gotten the list of cities, and in one case, I think even Los Angeles County as a full county that came in under that. And that's a pretty broad region. So again, if we're looking for individual risk versus what falls within an entire county, I think that those that are more precise individual, you're going to see a more meaningful discount when they can verify that. So I would say that you're probably not going to see as much there as elsewhere, simply because of the newness of this and what can potentially in some cases be such a broad region that's being reflected. So the short answer, it will be required to be acknowledged, but you'll see some variation.
Okay. And thank you to those of you who are sharing data points in the chat. Much appreciated. So another question, are insurers creating community discounts? So I guess that would be, how are they looking at that section of the regs that requires them to offer, to have their rates reflect community-wide risk reduction?
So the regulation requires individual parcel mitigation, so what was done to that home according to their specific list of features, and then separately a community recognition, which is meant to address the two. So FireWise is one of them in the regulation, and fire risk reduction communities is the other one. As you mentioned, FireWise, some companies are already doing that, and so they've already satisfied that for FireWise, but still need to build out those programs or discount for the fire risk reduction. FireWise, fortunately, has great infrastructure where they pass that information to a third-party vendor, which is then given to insurance companies directly. So one of the reminders that I might offer, because I know that since this regulation was finalized, is Michelle Steinberg and her team over at NFPA are getting an influx of calls or inquiries from residents going, hey, is my home in that? Can I get a discount? And their information is passed to insurance companies directly. So insurers will already have that information data feed because that's already built out and available to them. So there's no additional follow-up that's needed. So we actually would encourage you guys, they're obviously adjusting to the reg. Don't send more their way because that's going to end up overwhelming them. But that is already.
It's funny because we had her on and she was one of our speakers. And I asked her, I said, are you already overwhelmed? And she said, no, we're okay. But I
have heard there's been some influx now that it's finalized, and I don't know the extent of that. But
I think we probably have some hand in that. But okay, we have a question from MJ Lee. Can you please elaborate on how insurers are getting a hold of NFPA Firewise data? Is this through the community risk reduction databases?
It's not through the fire risk reduction community. That's a state program. So they have their own state list, which I think was from the Department of Forestry. They have published that list, and that list I think was referenced in the regulation. I can try to pull it up if I have time and drop it into the chat. The Firewise data is done through the private sector. So Firewise has their own arrangement through, and I believe it might be, I don't know if they've communicated that publicly, so I don't know, but they have a third-party vendor that's a well-established, very large vendor in the industry that many carriers have access to, and they send that information to them, and that data then is available to the insurance company. So that's kind of what I mentioned with the infrastructure, that data feed that gets passed back and forth, and they have that information. But the fire risk reduction communities is a state program, so they have created their state list, and to make it easier for insurance companies to capture that, they will probably see other third-party vendors that will take that information and put it into an easier way for their company systems to integrate that data into their, quoting applications and policy servicing applications and such.
Yeah. Okay. So Kate had a couple questions, but the one I'm going to pick here is, do you think the IBHS mitigation standards will become the default standard for insurers to measure mitigation discounts, or do you expect they'll come up with their own? So you probably know that this working group actually came first. We put out our list, and then IBHS, and then wildfire, the Safer from Wildfires, but they all look very similar, right? All good. So given that, and IBHS, of course, is a trade association. They're not they're a nonprofit, insurer funded nonprofit. So they are not a government authority. So what do you think? Is there going to be any other set of standards, or is this pretty much, do we have what we're going to get?
I think there's always potential for other standards to emerge. I think as an industry, the fact that they are a nonprofit and they are a science-driven organization, there holds a lot of credibility that we have looked to and had that experience. And so while certainly the RAP program has consistencies with that, we as the insurance industry, we want to go right to the science typically. And so with our success and how we've been able to leverage the Fortified program, there's a lot of familiarity there. And so I think that those best practices that have emerged in that space can carry over probably fairly easily as they continue to build this out. And again, it's that independent, credible, science-driven or science-based standard. And so I would assume that that's probably going to emerge. Again, each company is individuals. I can't speak to them individually, but as an industry, that is something that the way that we view kind of that source.
Yeah, because I mean, the IBHS standards that's the standard, right? In Florida, My Safe Home, the Fortified Home Program, et cetera. Kelly Berklumpus asks a question: would it be foreseeable in the future that insurance companies would pay for the upfront cost of retrofitting homes to help reduce their risks? And that's, I think, a very interesting question. And then some folks posted some answers on there, but I'd like to hear yours.
I can't speak for individual insurance actions. I know that I think I've seen with Wildfire Preparedness Month, State Farm has done a lot of community service work with providing what could be like grants that they award. So I think that you see a lot more of that done through a philanthropic arm to help communities versus paying for that individually. I know that there are some companies that are employing what they call, I think it's like wildfire defense systems. It's a benefit of policies that when there is a fire that emerges and there's some immediate, hardening that is needed to reduce that risk, they might send out services in that regard. So there's some of that. But, property ownership is with responsibilities, and we are trying to provide what is the standards and the science of what you can do, but there's got to be skin in the game that property owners also need to kind of step in and take some of that responsibility. I think that we are trying to help more so as an industry lobby for resources to help in those efforts. Here's the why you should do it, here's the how you should do it, and here's some resources to help achieve getting that done. And that's where we're trying to look at it through all of these lenses and keeping that momentum going. So I can't say that there's not going to be an individual company that does it, but at scale, there just may not be the ability from a cost perspective to do that, but we'll certainly continue to try to fill some of those voids in other ways that we can.
Yeah, well, great. Well, I think, we're pretty much out of time. If, and a couple people have asked for your contact information. So if you're willing to share that, it's your call. I don't want you to get, barraged, but if you're willing to, you can, throw your contact information in the chat. And one last question, if you don't mind answering. I think from the beginning, I've heard a lot of insurance company representatives say, we don't want to be responsible for ensuring continued brush clearance, for doing repeat inspections and going out and making sure that you're continuing to limb your trees and you're continuing to clear the brush and all that. Is there any kind of, do you feel like vendors are emerging or products are emerging that'll provide that? I think if I remember Roy Wright saying, if I remember right, I think he said that they will have an app for a wildfire prepared home enrollee or whatever to either like upload photos, or is that kind of how you envision it happening?
Yeah, so that's again the unique challenge of wildfires, that there is that recurring need for fuels management, and there's a lot of increasing conversation within the wildfire space of insurers have kind of been forced to step into that role of enforcer, but that's not really the role of what insurers are supposed to do. We can certainly support it to a degree through our underwriting, but that really is the role of local and state governments in managing sort of that aspect of it. With the Wildfire Prepared Home Program specifically, their designation program is a designation that can be earned that is good for 3 years, but requires annual reinspection. And they do have an app that they've developed that will facilitate that. I don't have all the specifics. We can bring IBHS back on to maybe help walk through that part of it in more detail if needed. I believe the Firewise community similarly, and this is why that one remained versus some others that were early in the list that didn't stay in that, is that there is the ongoing need for projects and actions to sustain that. And so the recurring aspect of it is certainly needed. If there are vendors that can come out and provide solutions, I'm sure insurers will be willing to consider and look into those. Again, are they credible, independent, all that stuff are things that they look to. But yes, there could very easily be other solutions that emerge, or even technology that maybe fills that gap. So there's a lot that everybody is looking at specifically to further this and find the efficiencies, as it relates to these challenges for wildfire.
Well, listen, you've been terrific. And thank you so much for joining us. We've come such a long way in a relatively short period of time as these things go, I think, from my first conversations with Rex Frazier years ago, where he said, there's nothing you can do, to move the needle and prevent homes from burning. And now we're really, I think there's just a lot of more kind of locking arms and going, okay, let's just try to take, each piece at a time, untangle it and do what we can. So thank you again for your time and your presentation. If you're willing to share it with us, I'm sure that, you can shoot it to Emily and we'll make it available to the attendees. And for all of you on the call, thank you again for the collaboration and the attention. We'll be back for our next meeting on December 6th. Same bad time and channel, 1 o'clock right here. Our speakers we'll have 2 speakers. We'll have Jill Santos from the Ventura Fire Safe Council, and they're doing great work. And then we'll have Carleon Safford from Sonoma, who's going to update us on a county-supported wildfire risk reduction program, kind of like Wildfire Partners in Colorado, but sponsored by Sonoma County. So really looking forward to hearing about that and more of the progress that people are making all over the state. So Karen, thank you again. We really, really appreciate your time.
I appreciate the time to speak, and thank you for the opportunity. I will send my contact information. It's been a crazy last couple months of the year, so I'm not always quick to respond, but I will be happy to share my information. I'll include the recent white papers also that we've released.
Great. And I know I'm going to see you next week in New Orleans.
that came up short notice on my radar, but we seem to be on a lot of the same panels talking wildfires. So
yes. All right, everyone. Have a good rest of your day. And thank you again to Team Up, Joel and Emily and Val and Ben. And we'll see you guys on December 6th.
Thank you.
Bye-bye.